On May 15, 2026, the Nifty 50 concluded the session down just 0.19. While the headline index moved very little, massive amounts of capital were rotating out of specific sectors and into others. Relying on a macro index to gauge daily health creates a blind spot. The Nifty 50's final number is currently masking the specific strategies institutional traders are executing in the background. To see what the algorithms are actually doing, we have to analyze market breadth, measuring how many individual stocks moved up versus how many moved down. The underlying market structure showed significant weakness, with 2,183 individual stocks losing value during the session. In contrast, only 1,409 stocks advanced, while 116 remained unchanged. This creates a 1.5-to-1 negative imbalance across the broader market. This ratio confirms that selling pressure was the dominant force across the physical economy, regardless of what the top-line index suggested. However, the India Volatility Index, or VIX, rose by only 0.1775 points. The marginal uptake in the VIX suggests the sell-off followed a calculated trajectory. It points to orderly liquidation of positions rather than a reactionary panic. The market is behaving like a deep ocean current. The surface remains glassy and still, but beneath the waterline, massive volumes of capital are being displaced. Institutional capital is being systematically extracted from specific sectors to be redeployed elsewhere. By tracking sectoral divergence, we can see exactly where that capital is fleeing and where it is finding refuge. If we map the net point changes of the major sectoral indices, the institutional strategy becomes visible. The financial sector saw the heaviest extraction, with the Nifty Bank Index dropping by over 418 points and acting as the primary drag on the market. This was followed by the energy and metal indices, which shed 263 and 261 points respectively, signaling a retreat from heavy industry and commodities. This collective decline across banking and industrials suggests a deliberate exit from cyclical sectors due to immediate concerns about the demand cycle. That capital moved directly into technology. The Nifty IT Index gained 356 points, supported by continued global demand for services. The FMCG sector also saw significant inflows, gaining 272 points as investors sought the stability of essential consumer goods. This is a classic defensive growth barbell strategy. Large players are hedging their risks with consumer staples while simultaneously chasing tech momentum, leaving the industrial middle of the market behind. This divergence is even more pronounced when we look at individual securities. The daily tape shows heavy selling concentrated in commodity proxies and financial services like Muthoot Finance. These assets are primary targets for the cyclical extraction across the broader indices. Yet, niche tech and utility stocks like Nazara and TD Power Systems recorded double-digit percentage gains. Achieving a 12-second tech resilience in IT and FMCG must prevent further index drag. Finally, a narrowing advance to decline breadth signals the structural weakness is breaking. Navigating this market requires dissecting the index. Headline numbers are designed to track the average, but they often hide the very rotation strategies that will dictate the next